Let me now bring on board Manishi Chaudhary, Managing Director and Head of Research with BNP Paribas. Manishi, morning. Thank you for joining us. Manishi, for the year FY12, benchmark indices were down by about 9%, but individual stocks, they did manage to outperform in a tough environment. Do you think the same story will continue for FY13 as well?
Yeah, I would think so, because India has always been a place where you have rather disappointing macro environment, but at the same time it's a place of good micro, which means that individual stocks tend to outperform the market, and there are good performers among even though the overall macro environment may not be too encouraging. So it was a stock pickers market in FY12, and I think it will by and large remain so in FY13 as well.
Manishi, for the calendar year FY12, foreign institutional investors have pumped in about $9 billion, and that is some kind of a record inflow. What are the sound bites you're picking up from some of your top institutional clients? Are they investing in India because they like the India story, or they're investing in India because there is global money and India happens to be part of the broader EM allocation?
I think it's more of the latter. Most of the emerging market investors or even Asia ex-Japan investors, they're getting more money into their funds, and therefore they're kind of forced to allocate it across the emerging market universe or the Asia ex-Japan universe. And therefore, if an investor is just about neutral on India, then he would end up investing close to 7.5 to 8% of his incremental inflows if he is benchmarked to the emerging market indices in India, or if he is into Asia ex-Japan, close to 10% of his incremental inflows into India. Those are the benchmark rates that India has. So I think currently what we are seeing is more of an impact of the tap being turned on in Europe and United States. It's basically global liquidity is sloshing around, and that is definitely finding its way into India.
But Manishi, what about valuations? Because the PE multiples have come down from the earlier 25 to now 15 odd times. That's looking comfortable. It seems like come April, and you are going to see some move on in interest rate cut as well from the central bank. So all indications, lead up to a healthy time to invest into equities.
Let me address these two issues separately. First, on the valuations, in fact, I would think that we're possibly even slightly cheaper than that 15 times that you talked about if you look at 1 year forward. So currently the Sensex is close to about 17,400 or 500, and the EPS estimate for Sensex that we have is about 1290, which could come down slightly, but even then, if it settles around 1260 to 1270, then the market is trading somewhere between 13.5 to 13.7 times. That's by no means expensive. The average for last 17 to 18 years has been about 15.2 times 1 year forward. So, this is close to about, maybe about 10% discount to what we had seen historically. But of course, it's not as cheap as it used to be in late December or early January, when it went down to one standard deviation below the mean. So it came down to about 12 to 12.2. That is where the market really appears cheap from the perspective of a global investor, in particular because India, despite the recent derating, still appears slightly more expensive than its regional peers. Maybe not as expensive as it used to be, but definitely still maybe trading about 15 to 20% premium compared to the Asia ex-Japan average. So that's as far as the valuations are concerned. Yes, India is cheap, but perhaps global investors would get more comfortable with India if it gets slightly cheaper than where it is right now. Now, on the monetary policy cycle, the interest rate cut, I think there's a widespread expectation that RBI would start reducing interest rates from April 17th. And, yes, I think, there is a thought process behind that. But at the same time, I don't think that's really a slam dunk kind of conclusion, because if you look at the inflation numbers that have been coming out, if you look at the concern on fiscal deficit in particular after the budget, I think those are the issues that RBI would have to grapple with. And even if they do initiate the rate reduction cycle, it may turn out to be a very shallow rate reduction cycle, nothing compared to what we have seen during that 2001 to 2004 period, and definitely nothing compared to the 2008 to 2009 episode. So I think that significant support that the investment cycle was expecting from monetary policy, that hope is now gradually receding. So I mean, this is one concern that the market would have to grapple with going forward. And as a consequence, even if we do see an uptick as a consequence of any rate adjustments in the monetary policy, it may turn out to be short-lived.
What's looking strong today is also India Bulls power that is locked up. It was locked up on Friday, it was locked up on Monday, and Tuesday, first thing Tuesday morning, India Bull power is once again locked up. I'm a bit surprised with price action in Kingfisher Airlines. 15.5 rupees for Kingfisher Airlines. By and large, momentum stocks are in a good groove. So Lanco is strong, JP is looking strong, IVRCL is at 71.5 now, and Titan is now at 250 rupees, which is almost a new lifetime high for Titan Industries. Manish, you just mentioned that FY13 will be a year of stock pickers. So where are you picking up your spots?
Yeah. So first of all, even within sectors which are, kind of domestic cyclicals, which are maybe growth sensitives in a sense, there are certain stocks which would appear to be relatively defensive, if I may use that term, because they offer some degree of visibility about revenues and cash flows. So, for example, take engineering and construction. It's a classic domestic cyclical. Within that sector, we like Larsen & Toubro and IRB. Larsen & Toubro because it's proven execution capabilities and it has a very strong balance sheet, which enables it to take more leverage on the balance sheet to bid for new projects. IRB infrastructure, clearly a play on the road sector, and roads is one segment within infrastructure that's doing well. Another area that we're bullish on are the autos. Stocks like Hero MotoCorp, Bajaj Auto, or M&M, for example, which is begun to improve just about as we speak. They possibly offer some degree of revenue and cash flow visibility to the investor universe. Third, telecommunication. There we think that the competition, the massive domestic tariff competition that we have seen, that's clearly behind us. It's visible in the ARPUs and ARPM improvements that we have seen over the past couple of quarters. So we like Idea Cellular and Bharti in that order. Finally, I would also name some of the so-called regulated utilities like Gas Authority of India, NTPC, and Power Grid Corporation. There also we are playing the same theme of revenue and cash flow visibility. And even though we are underweight banks and financials now, I think the private sector banks, maybe the HDFC family, and stocks like Axis Bank, they are relatively safe because they don't have the extent of concern about asset quality, which some of the public sector banks may have. So the point I'm trying to make is that, yes, there are certain sectoral biases that we have, but within those sectors, we're really trying to pick the relatively safer stocks, which don't have major earnings-related concerns going forward.
But Manish, what about banks and the move that they may showcase? If April there is a cut, do you think banks are going to be the one which are going to lead the market higher from here?
If there is a cut in April, then possibly yes. The banks would possibly move up. But, if you look at what has happened in the past 2 to 3 months, the banking universe has already outperformed significantly. And one has to look beyond that initial rate cut. Particularly for the public sector banks, we will have to watch out for asset quality. And also for the entire banking universe, we have to watch out for the net interest margins. Because even if there's a rate cut, it may get passed on first through the lending rates. And the deposit, or rather through the deposit rates, and the lending rates may come in later on. So, you may have a situation of temporary net interest margin compression for the banking universe.
So, Manishi, if you have to construct a high-risk, high-return portfolio for your clients, what will be the complexion of that portfolio?
Well, you kind of put me in a spot because, the portfolio that we have currently is, it's not just high-risk, high-return, but there are elements of defensive, rather low-risk stocks there also. But if I were to choose some, high-risk elements out of that portfolio, I'll possibly go with a combination of Axis Bank in the private banking sector, possibly Larsen & Toubro in the engineering and construction space, maybe one from the deep cyclicals, like the global cyclicals, perhaps JSPL, Jindal Steel and Power in the metal side, and one from the auto side. I'm tempted to pick Tata Motors or Mahindra & Mahindra in that universe.